They're saying it's done. They're saying Congress quietly slipped a provision into a must-pass bill, and the capital gains tax on silver just jumped to 39%, effective immediately. No hearings, no headlines, no warning. Just a signature and a new reality. And if you've seen those claims circulating on YouTube, on X, in Discord groups, even in dealer newsletters, you're not alone. The panic makes sense, because if that were true, it would fundamentally change the economics of stacking silver, buying bullion, and ever taking profits. But here's the problem. As of right now, under the actual federal framework, investors can verify, physical precious metals are treated as collectibles, and long-term gains are generally subject to a maximum 28% federal rate, not 39%. Short-term gains are taxed as ordinary income. So what's happening? A viral narrative has taken a real unpopular truth. The tax code already discriminates against gold and silver and then escalated it into a stealth confiscation story with specific section numbers and dramatic language that sounds legislative, even when it doesn't match what's publicly trackable in the tax code or mainstream tax references. Today, I'm going to do what the financial press usually won't. I'm going to walk you through the real tax mechanics that hit silver owners, why the 28% collectible structure is already punitive, what a 39% regime would mean if it ever became law, and the smartest legal strategies serious stackers use to protect themselves, because whether the number is 28% or 39%, the core game is the same. This is about after-tax reality. This is about the rules that decide whether your profit is actually yours. Let's start with the baseline. In the United States, physical silver bars, rounds, many coins, bullion products falls under the IRS collectibles category for capital gains treatment. That category has its own maximum long-term rate, commonly summarized as up to 28% on long-term gains, instead of the 0% or 15% to 20% structure most people associate with stocks. That difference is not academic. It means two investors can make the same dollar gain, one on a stock, one on silver, and the silver investor can owe substantially more federal tax simply because the asset is tangible. And that's before we even talk about state taxes, spreads, premiums, dealer reporting thresholds, or the paperwork gap that destroys people at audit time, cost basis documentation. Now, the 39% story usually comes packaged with a here's the section, here's the title, here's the code change style of language. It's designed to feel undeniable, but when you compare it against accessible public references, tax law summaries, practitioner guidance, and the way collectibles gains are routinely described, the widely cited framework remains the same. Collectibles long-term gains are capped at 28%, and short-term gains are ordinary income. So if you're hearing 39% effective immediately, treat it like you should treat any viral tax claim. Verify first, then plan. Because even if the 39% headline is wrong today, the directional risk is real. Tax policy changes, rates move, reporting tightens, enforcement expands. And the one thing you never want to do is build a strategy on vibes and panic. Now, let's do the math. People think they're doing, then correct it. Say you bought silver at $30 and sold at $75. That's a $45 gain per ounce. Under a hypothetical 39% federal rate, you'd lose $17.55 per ounce to federal tax. Under a 28% rate, it's $12.60 per ounce, still brutal, just less brutal. The difference is $4.95 per ounce, and across a serious stack, it's real money. But here's what most people miss. Your tax reality is not just the rate. Your tax reality is the rate plus your state, plus whether you're actually long-term or short-term, plus whether your basis is clean, plus whether you're paying collectible treatment or something else via a different vehicle, plus the spread you pay when you sell. This is why two silver investors can make the same market gain and end up with completely different outcomes. And this is why the collectibles structure matters so much. Because unlike stocks, where long-term capital gains rates are widely understood and broker statements spoon-feed you, basis physical silver is often purchased across multiple dealers, multiple premiums, multiple formats, sometimes cash transactions, sometimes trades, sometimes inherited, sometimes gifted. That creates the single biggest vulnerability in precious metals taxes: basis ambiguity. And ambiguity doesn't help you at audit time. So, before we go any further, let me translate the real rule into plain language. If you profit on physical silver and the position is long-term, you may owe up to the collectible's maximum rate, commonly summarized as 28%, and if it's short-term, you're in ordinary income territory. Now let's talk about why the viral 39% claim feels so believable. Because people already sense the system is stacked. They already know precious metals are treated differently. They already watch the government tighten financial reporting, expand data collection, and grow enforcement tools while deficits explode. So when someone says they couldn't ban silver, so they taxed it into a cage, it lands emotionally. It fits the narrative. But emotion is not a filing position. Now let's shift from rumor to strategy. Because whether you're dealing with the current collectibles framework or a future rate hike, the playbook for protecting yourself is the same and serious investors already use it. You start with the asset level mechanics. Physical silver is not a brokerage account. It doesn't automatically generate perfect tax records. So you create them. Receipts, confirmations, screenshots of orders, dealer invoices, serial numbers if applicable, photos of tubes and bars tied to purchase dates, spreadsheets that track ounces, premiums, shipping, and all-in cost per ounce. Because for tax purposes, your gain isn't spot went up. Your gain is sale proceeds minus your cost basis. And if you can't prove basis, you're begging to overpay. Next, you stop treating sell as the only exit. This is where sophisticated holders think differently. If the government wants revenue at the moment you realize gains, the obvious lever is simple. Don't realize gains unless you must. That doesn't mean never sell. It means you plan the event. You evaluate whether you can meet your liquidity need without triggering a taxable sale. Sometimes that means using other assets first. Sometimes it means structuring timing. Sometimes it means partial sales. Sometimes it means offsetting gains with other losses where applicable. And yes, sometimes it means professional planning. Because the biggest mistake in precious metals taxes is thinking it's too simple to require strategy. Now let's talk about the most important concept that separates amateurs from pros. Tax policy is not static. If a future Congress ever did push a punitive increase, whether it's 39% or something else, the people who get crushed are the people who planned as if the rules would never change. The people who survive are the people who built systems. Documentation systems, liquidity systems, exit systems. And that brings us to the part nobody likes, but everyone needs, state taxes. In many states, capital gains are taxed as ordinary income. That means your combined burden can be materially higher than your federal rate alone, depending on where you live and what your income looks like. So when you hear anyone throw out a single national percentage as your total tax, you should immediately recognize it as incomplete. Your real after-tax outcome is jurisdiction-specific and situation-specific. Now let's talk about the why. Why does the government treat silver like this? Why does the code make it easier to profit after tax on paper assets than on tangible money? The simplest answer is the one nobody in polite finance wants to say out loud. The modern financial system prefers assets that live inside the system. Brokerage assets, bank-custodied assets, highly intermediated assets, assets that generate automatic reporting and frictionless taxation. Physical silver is the opposite. It's outside. It's bearer adjacent. It's privacy-friendly when acquired legally. It's not a line item in a brokerage dashboard that can be frozen with a keystroke. So yes, the collectibles classification has the practical effect of making metals less competitive after tax than stocks for many investors. And that's exactly why rumors like 39% spread so fast. Because they don't feel like a leap. They feel like the next step. Now let's do something useful. Scenario plan. If a future law ever did push precious metals gains toward a flat, higher rate, what would that change? It would compress your after-tax return dramatically. It would raise the required outperformance of silver versus stocks just to break even after tax. It would punish active trading even more than it already does, and it would push more investors into longer holding horizons and alternative liquidity strategies. And it would increase the value of one thing above everything else: tax-efficient structure. Not avoidance, not games. Structure. So what are the legitimate levers? You look at holding vehicles where appropriate. You look at timing. You look at charitable strategies if you already give. You look at gifting strategy if it fits your family plan. You look at estate planning realities, because there is one tax rule that has ended more precious metals tax debates than any YouTube rant ever will. A stepped-up basis at death can wipe out lifetime appreciation for heirs under current norms, making hold a very different proposition than trade. If you've never had a qualified professional explain how that interacts with your metals, your real estate, your equities, and your broader estate plan, you're operating blind. And here's the key. None of this requires believing a viral rumor. It requires understanding the existing framework and building resilience against change. Now, let me address the viewer psychology, because this is where most channels manipulate you. If you're angry, that's normal. If you feel targeted, that's normal. If you feel like the rules are designed to reward paper wealth and punish tangible savings, you're not crazy, because the collectibles treatment is openly described as a different, higher maximum rate than typical capital gains. But anger doesn't lower your tax bill. Systems lower your tax bill. Documentation lowers your tax bill. Planning lowers your tax bill. So here's what I want you to do, starting now. Get your basis house in order. Every ounce, every purchase, every premium, every shipping charge that belongs in cost. Know what you actually paid. Know what you'd actually owe. Because the moment you treat your stack like a real portfolio with records, you stop being the easy target. Then stop making sales emotionally. Selling because of headlines is how people get wrecked. Selling because you have a plan is how people stay solvent. If you need liquidity, explore options. If you don't need liquidity, recognize what high taxation really does. It increases the value of patience. And finally, stop outsourcing your beliefs to the loudest voice in the room. If someone tells you a 3,000-page bill just raised silver gains tax to 39% effective immediately, don't share it. Don't panic sell. Don't let someone farm your fear for clicks. Verify, then act. Because in finance, the crowd is usually late and the crowd is usually wrong. Now, if you want a clean, reality-based headline you can actually stand behind, it's this. Silver profits are already taxed differently than stocks because physical metals are treated as collectibles, and that can mean up to 28% on long-term gains at the federal level. That's the story. That's the truth. And that's enough to justify smart planning without inventing a number. If this helped you cut through the noise and understand the real bullion tax rules, like so this reaches more stackers who are about to get blindsided at tax time. Subscribe if you want clean, verified updates on silver, gold, inflation, IRS rules, and the real-world mechanics the mainstream financial media skips. Because the tax code doesn't care about your opinion. It cares about your paperwork. And if you're going to play this game, you play it with eyes open.